all things commodities as well, because there is a lot of geopolitical uncertainty. Manisha Gupta spoke with John Reade of the World Gold Council to find out if he still remains bullish on gold, given the sort of global uncertainty.
I think gold's done a lot of work this year. I mean, I think when we put out our outlook in December, we were expecting gold to have a positive year. Nowhere near as positive as we saw in 2024 when it delivered 26% in US dollar terms. And already this year it's done pretty well. So I think investors should be pleased about the performance of gold. And, it's showing signs now in the short term, potentially, of a bit of correction. So I'm sure that 3,000 will trade at some point this year. Quite when, difficult to say. But I don't think investors should be looking for the same sort of gains that they saw last year in gold. And they need to temper their optimism, I think, to a degree.
John, the COMEX holdings has been one talking point where we saw gold being brought into New York from UK and various other countries as well, but majorly UK. Has that changed the kind of balance that we've seen in physical gold in many, many years around the world?
I think so. I mean, we've now sitting with stocks of gold in New York, which are very close to all-time highs. Those all-time highs were reached during the COVID pandemic, when a lot of gold was shipped to New York to take advantage of the price discrepancies between the US futures market and the London OTC market. This time around, gold has moved to New York about 600 tons since the beginning of November, has moved to New York just in case tariffs come in. Because if tariffs come in, it suddenly would get a lot more expensive for traders to ship physical gold into New York to deliver into futures contracts. So this has led to an unusual amount of gold in New York, and it's led to temporary shortages of gold in the London market.
And would you call this as an aberration? Because the last time we saw it was COVID, and now it's happening now because of tariffs. Do you see this as a pattern? Do you think it as a short-term phenomenon?
I think that this positioning of gold in New York will probably stay there until we have clarity about what tariffs the new US administration is going to introduce around the world, and confidence that those tariffs won't change quickly. Now, I'm not sure when we're going to have any confidence about the US administration, because it seems to be saying 1,000 times things 1,000 times a day at the moment. And, even if they were to say that gold would not be subjected to any import tariffs, would you believe that that couldn't possibly be changed in 6 months' time? So I think these stocks of gold that have moved to New York are going to stay there for a while. I think the temporary shortages in London, though, which have been caused by delays in getting the gold out of the Bank of England, those are already showing signs that they're coming to an end. So I think the rest of the gold market is beginning to normalize, but the large stocks that have traveled to New York are likely to stay there, I think, for the balance of this year, maybe even next year as well.
John, the other thing that we've seen in this year being quite supportive is the ETF buying globally and for the Indian markets as well. This is something that we didn't see as a support in the previous year. Last year was about central bank buying and strong returns, but it clearly is about ETFs right now.
ETFs have played a big role, and they actually started to turn positive around the middle of last year. But the strength we've seen in ETF buying in the first 2 months of this year has been a bit surprising. I think we'll see when we finally mark the end of February that this will have been the strongest month of inflows that we've seen for many years. And it's mostly going into US ETFs. In January, it was more balanced towards European ETFs. But your point about Indian ETFs is certainly a good one. We saw buying from Indian ETFs steadily last year, and that looks set to continue.